Gildan Media, a division of Recorded Books, presents Mergers and Acquisitions from A to Z, 4th edition, by Andrew J. Sherman. Narrated by Eric Martin. Introduction to the 4th edition. It was the best of times, it was the worst of times. When Dickens first shared this quote with the world, he was not referring to the current state of the merger and acquisitions, M&A, markets, but he might as well have been. In the time between the publication of the 3rd edition of this book in 2010 and today, the overall financial market and the levels of M&A activity have experienced both polar opposites and everything in between. From the seemingly insatiable appetite for middle-market companies that private equity firms and other buyers had in 2006 and 2007, thereby driving valuations through the roof, to the fast ending to the party and the sobering effects of a virtual halt in 2008 to 2009, sending valuations on a downward spiral, to the tepid economic recovery and GDP growth from 2012 to 2016, this was not a good time if you prefer merry-go-rounds to roller coaster rides at the amusement park. According to Merger Market, there were 17,369 deals announced worldwide in 2016 and 4,951 deals in the United States, with a total value of $3.25 trillion. These figures represent a wide variety of industries driven by a wide range of strategic and financial buyers, with the biggest deal of the year being AT&T's proposed high-profile acquisition of Time Warner for over $100 billion, which at the time of publication had been challenged by the Department of Justice, late 2017. Merger and acquisition activity in the United States increased slightly in terms of the number of deals from the first quarter of 2017, the total deal value being 3,554 deals worth $678 billion, an 8.9% increase over Q1 of 2016. In January of 2017, the value of M&A deals worldwide for the month totaled $280 billion, the second largest January for M&A on record. But things began to cool as the reality of the challenges to implementing the economic and tax aspects pieces of the Trump agenda began to set in. By mid-year 2017, global M&A deals were at $1.59 trillion, down well over 15% from 2016 deals at the half-year point. Mergers and acquisitions are a vital part of both healthy and weak economies and are often the primary way in which companies are able to provide returns to their owners and investors. Mergers and acquisitions play a critical role in both sides of this cycle, enabling strong companies to grow faster than their competition and providing entrepreneurs with rewards for their efforts, while ensuring that weaker companies are more quickly swallowed, or worse, made irrelevant through exclusion and ongoing share erosion. Mergers and acquisitions have played a variety of roles in corporate history, ranging from the greed is good corporate raiders buying companies in a hostile manner and breaking them apart in the 1980s, to today's trend of using mergers and acquisitions for strategic growth and to foster industry consolidation. During the 1980s, nearly half of all U.S. companies were restructured, more than 80,000 were acquired or merged, and over 700,000 sought bankruptcy protection in order to reorganize and continue operations. The 1980s featured swashbucklers and the use of aggressive tactics to gain control over targets. The 1990s were equally dynamic in terms of companies evolving through upsizing and growth, downsizing, roll-ups, divestitures, and consolidation, but focused on operational synergies, scale efficiencies, increases in customer bases, strategic alliances, market share, and access to new technologies. This period, however, came to a crashing end with the bursting of the tech bubble and the global recession that followed. The wave of M&A activity seen from 2004 to 2007 was driven by the more general macroeconomic recovery and several key trends. First, many companies had exhausted cost-cutting and operational efficiencies as a means of increasing profitability and were looking to top-line growth as a primary enabler of shareholder return. The increased pressure to grow turned the spotlight on the opportunity to achieve growth through acquisition. Second, the M&A market had been supported by the return of corporate profits and with them improved stock price valuation. The improved valuations enabled corporations to leverage their internal currencies to acquire target companies that were willing to swap their illiquid private stock for valuable public company shares. Third, interest rates were hovering at historical lows, enabling firms to cost-effectively utilize debt to finance acquisition-based growth. From 2008 to late 2009, the wave of M&A activity was driven by weak economic conditions around the globe. The strong, cash-rich companies and firms began bargain shopping, picking off distressed and downtrodden competitors at a fraction of their market value compared to expectations just a short 12 to 18 months earlier. Today, many large and mid-size companies have begun to refocus on their core business lines, triggering divestitures and spin-offs of underperforming divisions or subsidiaries. Private equity firms and even hedge funds, under pressure to provide returns to their limited partners, have turned stepchild investments into small buckets of cash in order to hold off a tyranny or management overthrow. Yet, although so many dollars have been changing hands, the number of readily available resources for business executives and professional advisors to turn to for strategic and legal guidance on mergers and acquisitions remains very limited. This book is intended to be such a resource. There is no more complicated transaction than a merger or acquisition. The various issues raised are broad and complex, from valuation and deal structure to tax and securities laws. The industries affected by this rapid activity are also diverse, from banking and computer software companies to retailers and healthcare organizations. It seems that virtually every executive in every major industry faces a buy or sell decision at some point during her tenure as leader of the company. In fact, it is estimated that some executives spend as much as 1/3 of their time considering merger and acquisition opportunities and other structural business decisions. As we will see in the chapters to follow, the strategic reasons for considering such transactions are also numerous, from achieving economies of scale to mitigating cash flow risk via diversification to satisfying shareholders' hunger for steady growth and dividends. The degree to which the federal government intervenes in these transactions varies from administration to administration, depending on the issues and concerns of the day. During the Reagan-Bush years, the government took a passive role, generally allowing market forces to determine whether a given transaction would have an anti-competitive effect. During the Clinton years, regulatory bodies took a more proactive approach, with more intervention by the U.S. Department of Justice and the Federal Trade Commission, such as a refusal to provide the necessary approval for the proposed merger of Staples and Office Depot in mid-1997. The second Bush administration took a more laissez-faire approach, only to have the European Union take a more aggressive role in preventing potentially anti-competitive mergers. The European Competition Commission's landmark rejection of GE's proposed acquisition of Honeywell in 2001 signified a shift in the role that the EU played in the global M&A marketplace. Under the Obama administration, we saw an increase in antitrust and regulatory oversight, but also experienced an anxiousness to facilitate transactions that will be beneficial from an economic recovery perspective. Transactions such as AT&T Time Warner were approved, yet the DraftKings FanDuel and Walgreens Rite Aid transactions failed to secure antitrust approval. Under the Trump administration, we are likely to see a Bush-like approach to M&A approvals and some regulatory and tax reform that will directly and indirectly impact M&A activity. Recent years since the publication of the third edition have seen upticks in cross-border transactions, aggressive acquisitions by private equity, strategic tech and social media consolidations, and participation in a wide variety of industries. What can we learn and what can we predict about the future when we observe transactions as diverse as Microsoft buys LinkedIn for $26.2 billion in 2016. Facebook buys WhatsApp for $19.5 billion in 2014 and buys Instagram in 2012 for $1 billion. Google buys Motorola's patent portfolio for $13 billion in 2012. Apple buys Dr. Dre's Beats Music for $3 billion in 2016. Priceline buys OpenTable for $2.6 billion in 2014. Sycamore Partners, private equity, acquired control of retailer Staples for $6.9 billion in June of 2017. Amazon buys Whole Foods in June of 2017 for $13.4 billion, sending ripples of fear and concern throughout the retail and grocery industries as to what's next for Amazon and its already well-established online retail dominance. DuPont and Dow announce a merger in December 2015 that was expected to finally close in late 2017 to create a $150 billion chemical and industrial behemoth, and soon thereafter Huntsman, the political family, corporation, and Clariant merge to create a $14 billion chemical giant and drive over $300 million in cost savings. Defense contractors were active in 2017 in anticipation of Trump administration upticks in budget, with Northrop buying Orbital ATK for $7.5 billion and United Technologies merging with Rockwell at a deal valued at over $20 billion. Yahoo sells the bulk of its assets to Verizon for $4.48 billion in 2017 and spins off other strategic assets to newly created Altaba, whose shares climbed in the summer of 2017. High Times magazine is sold to a group of private investors led by Adam Levin and Damian Marley, Bob's son, for $70 million, as the legalization of marijuana in many states has led to a surge of interest in its content and readership. Medical supply manufacturer Becton Dickinson & Company announced plans in May 2017 to buy rival CR Board for $24 billion, and in a similar transaction, Actelcon was sold to Johnson & Johnson for $31.4 billion. Both deals fetched much higher than usual valuations for transactions in this industry. Longtime rivals QVC and Home Shopping Network agreed to merge in July of 2017 to drive efficiencies and synergies in an all-stock transaction valued at $2.1 billion. Both companies cited a need to stay competitive with Amazon among their reasons for doing the deal. Cabela's agrees to sell to rival Bass Pro Shops in 2016 for $4.2 billion, creating an outdoorsman and outfitters that will have a significant market share and brands in specialty retailing. 7-Eleven acquires the Sunoco chain of gas stations in 2016 for $3.3 billion in a classic vertical integration transaction that will strengthen both brands as co-branded locations roll out aggressively in 2018 to 2020. Reckitt Benckiser Group, UK, acquires Mead Johnson Nutrition for $16.6 billion in 2017, as it considers the sale of its own food division that includes the French's mustard brand, which spice maker McCormick recently bid $4.2 billion to acquire. Technology and government contract services giant Computer Sciences Corporation, CSC, merges with a spin-off of Hewlett-Packard to create a $25 billion combined entity. Nestle pursues upscale retail concepts in buying Blue Bottle coffee shops in 2017 to compete in part with the Starbucks rollout of its high-end Reserve brand of coffee bars. JAB Holdings, a growing chain of coffee and breakfast concepts, buys bakery cafe chain Panera Bread Company for $7.5 billion. Burger King buys Popeyes for $1.8 billion in early 2017, and Arby's owner Rourke Capital buys Buffalo Wild Wings restaurant chain for $2.9 billion in late 2017. Honeywell is buying Evoca to expand its water technologies offering for $3.6 billion. At the same time, it's spinning off its aerospace division as it shifts pieces around the strategic chessboard. Standard Life and Aberdeen Asset Management join forces in Europe to create a $4.7 billion money management and financial services firm. Leidos acquires the IT services division of Lockheed Martin in 2016 for $4.6 billion. MBE Worldwide buys its rival franchisor Postnet in May 2017 to create a combined specialty retailer with more than 3,200 locations in more than 30 countries. Coach reaches out to a younger, hipper target demographic customer as it acquires rival Kate Spade for $2.4 billion in May of 2017. Janitorium and building services conglomerate ABM Industries buys rival GCA Services for $1.25 billion in July of 2017 to further strengthen its market share and range of commercial services. Payment processing and financial services conglomerate Vantiv acquires rival WorldPay Group plc, UK, for $10 billion in July of 2017. Single-family home Landlord's Invitation Homes and Starwood Waypoint Homes announced a $4.3 billion merger in August of 2017, which combined would create an entity with over 82,000 homes for rent in over a dozen major cities. The primary impact of the deal was to create efficiencies as foreclosure sales and bargain home prices become scarcer. VF Corp, the owner of clothing brands North Face and Timberland, announced plans to buy Williamson-Dickie Manufacturing for $820 million in August of 2017 to expand its clothing and underwear brands. Dickies is an established career apparel branch, which competes with Carhartt and Duluth Trading Company. Kellogg is diversifying its breakfast snack offerings by buying protein bar maker RX Bar for $600 million in October of 2017. Facebook buys virtual reality equipment maker Oculus in 2014 for $2 billion, with an eye on the rapidly growing VR market. By 2017, its bet had more than paid off, as VR hardware was among the hottest products in consumer electronics, with Microsoft, HTC, and Samsung all playing catch-up to Oculus. Discovery Communications acquires Scripps Networks, including the Food Network and HGTV, for over $11 billion in August 2017 to drive a consolidation in content and channel programming. But not all deals planned came to fruition, either due to antitrust or regulatory concerns, loss of transactional momentum, or shifts in the marketplace. Kraft Heinz's attempted takeover of Unilever for $143 billion in 2016 ran out of gas. The Walgreens-Rite Aid merger derailed due to antitrust concerns in mid-2017, though Rite Aid did ultimately agree to sell 2,186 out of its total 4,600 shares to Walgreens for $5.18 billion, ending over 2 years of negotiations. Healthcare giant Anthem terminated its plan to acquire rival Cigna for $54 billion in May of 2017, citing legal, regulatory, and shareholder approval challenges. The fantasy sports company merger between DraftKings and FanDuel was called off in early 2017, as neither company was confident that it could overcome antitrust challenges to the deal filed by the Federal Trade Commission in late 2016. And Abercrombie & Fitch shelved its talks with potential suitors in July of 2017 when retailer valuation concerns failed to produce viable offers from Express, American Eagle, and others. It was especially challenging for Abercrombie to fetch a reasonable valuation when many of their rivals, including Wet Seal, American Apparel, and Aeropostale, had filed for bankruptcy in the previous 12 months. And many deals failed to meet strategic expectations and cratered on a post-closing basis, such as Starbucks' decision to close all 379 Teavana stores in July of 2017 after paying $620 million for the tea specialty stores in 2012. A wide variety of M&A trends are emerging that will probably predict the next 5 to 7 years of activity through 2025, or at least through the publication of the 5th edition. These include: the Trump effect of the 2016 election has caused massive uncertainty in the markets, leading many executives to sit on the sidelines as they await clarity and actions on tax reform, trade barriers, health care reform, infrastructure spending, immigration reform, and foreign policy. China is not going away anytime soon as an acquirer and cross-border deal-maker as its economy slowly creeps toward capitalism. Several estimates are that up to $1.5 trillion will be allocated to cross-border M&A over the next 10 years, 2018 to 2028. The aging of the baby boomers and rise of the millennials will trigger the greatest intergenerational wealth transfer in the history of mankind, in many cases via M&A, estimated at over $40 trillion over the next 20 years, according to the latest report by MassMutual. Cash stockpiles swelled to $10+ trillion worldwide by the fall of 2017, as cash sitting in thousands of corporate treasuries sat on the sidelines in search of reasonable yield in returns. Recent years have also seen a significant increase in merger and acquisition activity within industries that are growing rapidly and evolving overall, such as healthcare, information technology, education, infrastructure, and software development, as well as in traditional industries such as manufacturing, consumer products, and food services. Many of these developments reflect an increase in the number of strategic buyers and a decrease in the amount of leverage used, implying that these deals were being done because they made sense for both parties, which is very different from the highly leveraged, financially driven deals of the late 1980s. The small to middle market transactions have clearly been the focus of this book in each of its editions since the 1990s. Fortunately for this audience, middle market transactions continue to attract compelling valuations. Companies in the small to middle market segment need to understand the key drivers of valuation, since they are often able to focus their operating goals in order to maximize the potential valuation range. Therefore, it is important to know that the multiple a company achieves for its business is directly correlated with the following 7 characteristics. 1. Strong revenue growth. 2. Significant market share or a strong niche position. 3. A market with barriers to entry by competitors. 4. A strong management team. 5. Strong, stable cash flow. 6. No significant concentration in customers, products, suppliers, or geographic markets. 7. Low risk of technological obsolescence or product substitution. Successful mergers and acquisitions are neither an art nor a science, but a process. In fact, regression analysis demonstrates that the number one determinant of deal multiples is the growth rate of the business. The higher the growth rate, the higher the multiple of cash flow that the business is worth. A study of deals that close with both buyer and seller satisfied shows that those deals largely followed a sequence, a pattern, a series of steps that have been tried and tested. This book focuses on conveying this process to the listeners as we seek to understand the objectives of both buyer and seller in chapters 2 and 3, move through the process of negotiations and closing in chapters 4 through 11, and focus on closing and beyond in chapters 12 through 15. For example, when a deal is improperly valued, one side wins big while the other loses big. By definition, a transaction is a failure if it does not create value for shareholders, and the easiest way to fail, therefore, is to pay too high a price. To be successful, a transaction must be fair and balanced, reflecting the economic needs of both buyer and seller, and conveying real and durable value to the shareholders of both companies. Achieving this involves a review and analysis of financial statements, a genuine understanding of how the proposed transaction meets the economic objectives of each party, and a recognition of the tax, accounting, and legal implications of the deal. A transaction as complex as a merger or acquisition is fraught with potential problems and pitfalls. Many of these problems arise either in the preliminary stages, such as forcing a deal that shouldn't really be done, such as some couples were just never meant to be married, as a result of mistakes, errors, or omissions owing to inadequate, rushed, or misleading due diligence, through not properly allocating risks during the negotiation of the definitive documents, or because integrating the companies after closing became a nightmare. These pitfalls can lead to expensive and protracted litigation unless an alternative method of dispute resolution is negotiated and included in the definitive documents. This book is designed to share the pitfalls of such transactions, with the hope that buyers and sellers and their advisors can avoid these problems in their future transactions. Finally, with merger and acquisition activity continuing to grow at rapid rates, and entrepreneurs and venture capitalists continuing to form new entities and pursue new market opportunities, it is critical to have a firm grasp of the key drivers and inhibitors of any potential deal. With so much money on the line, it is essential to understand how to maximize price and valuation goals while ensuring that the transaction is successfully consummated. Andrew J. Sherman, Washington, D.C., Fall 2017. Chapter 1. The Basics of Mergers and Acquisitions. Over the past few decades, we have seen countless examples of companies, such as Amazon, Facebook, General Electric, Google, and Cisco, that have grown dramatically and built revenues through aggressive acquisition programs. Seasoned executives and entrepreneurs have always searched for efficient and profitable ways to increase revenues and gain market share. The typical strategic growth options are as follows: organic, inorganic, or by external means. Examples of organic growth are hiring additional salespeople, developing new products, and expanding geographically. The best example of inorganic growth is an acquisition of another firm, something that is often done to gain access to a new product line, customer segment, or geography. Finally, external revenue growth opportunities include franchising, licensing, joint ventures, strategic alliances, and the appointment of overseas distributors, which are available to growing companies as an alternative to mergers and acquisitions as a growth engine. This book discusses the benefits of organic versus other forms of growth. This book also focuses primarily on mergers and acquisitions, M&A, as a means of growing, although toward the end of the book certain external means are explored as well. M&A Basics: Buy versus Build. At the heart of all decisions regarding mergers and acquisitions, regardless of the global financial crisis, is a fundamental question. Are we better off buying a new capability, market entry, customer base, earnings opportunity, and so on, or attempting to build it ourselves? The dedication of financial and human resources to organize growth must be based on long-term sustainable value creation for the company's stakeholders, but achieving this objective through growth may require a high level of patience and may result in some lost opportunities. The allocation of resources to M&A will tend to expedite the achievement of growth objectives, but it also increases the level of risk if deals are not structured and negotiated properly. What variables should a growing company consider in striking the right balance between organic growth, build, and mergers and acquisitions, buy? These include the competitiveness, fragmentation, and pace of your marketplace and your industry, your access to and cost of capital, the specific capabilities of your management and advisory teams, the strength and growth potential of your current core competencies, the volatility and loyalty of your distribution channels and customer base, the degree to which speed to market and scale are critical in your business, including typical customer acquisition costs and timeframes, the degree to which your company operates in a regulated industry. Understanding key terms. The terms merger and acquisition are often confused or used interchangeably. It is important to understand the difference between.
Sample complete. Ready to continue?